In this episode, we're going to discuss the current market decline. As of this recording, we are seeing the stock market continue to drop for a number of days. And what should you as an investor do next? Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following 4 topics. We'll take a look at the current state of the market as of this recording, March 18th, 2025. Then we're going to look at why did the market decline. Then we'll take a look at what happens typically after a market goes down, and then how to invest now. So we're going to keep it simple. We're going to get started with our topic number 1, the current state of the stock market. So in order to keep it simple, we're just going to take a look at the Dow Jones Industrial Average. In other words, it's also referred to as the Dow or Dow Jones. It's basically a list or an index of 30 US companies that are the biggest and most established in the US. So the Dow gives us a quick temperature check of the economy. Is the economy doing well, or is the economy not doing so well or dropping? So we can take a look at the Dow and we can get a, just like I said, a quick temperature check of where the economy is at today. The Dow is made up of 30 companies. You can see the entire list on the screen right now. You'll recognize a lot of the names here. We have Home Depot, Johnson & Johnson, Nike, Disney, Coca-Cola, Amazon, Apple, Verizon, Walmart. So it is a list of, like I said, the most established and biggest companies in the US. For anyone that is interested, Procter & Gamble has been on this list since 1932. So let's take a look at where we are sort of in the last 30 to 60 days. I guess the first, maybe even a little longer, we're going to look at starting in December 4th of 2024. The Dow reached an all-time high, which was 45,014 points. And so that was on December 4th on 2024. And you can see on the graph up on the screen, since December 4th and until today, as of this recording, March 18, you can see that the market did drop considerably. Then it went up a little bit in February, and then it dropped even lower. So looking at the graph, things don't look so good, and it can certainly look scary when you see something like this. And on January 31st, the highest that the Dow has reached this year, so we're only looking at 2025 now, so we're going to ignore December 4th for a minute. So this year in 2025, on January 31st, the Dow reached a high of 45,054 points. And on March 14th of this year, it reached its lowest point in 2025. And the lowest point was 41,057 points. And so that represents a decline of 8.9% in a short period of time. So now let's take just a quick look back at the last 17 days and see what the market's been doing. And we can see here that the market did, in fact, of course, drop March 13. Then it came up a little bit, and then it dropped a little bit as of this recording. So it's kind of doing sort of down and then up and then down again. So the good news, if you want to consider it good news, and I think a lot of people will say it isn't good news, but the market did come up a little bit since March 13. So from its January 31st high, the decline is now 7.8%. So instead of roughly 9% decline, we're sitting at, as of this recording, minus 7.8%. So we're down almost 8%. So why did the market decline? Why is this happening? Right? This is a big decline. Usually we do see the market, go up and down every day, every week, every month. There are ups and downs, but this was a significant drop of anywhere from 9 to 8% drop in the stock market. So why did this happen? And so in one word, tariffs. And I covered those in a little bit more detail, and we went through the history of tariffs in the US and the market's reaction to that every time tariffs were introduced. And so we cover all of that in episode 89. So if you haven't seen it, I highly recommend you go back and watch episode 89 if you're interested in learning more about tariffs and their impact on the stock market. So where we are now, again, as of this recording, kind of the middle of March in 2025, you can see there's no shortage of headlines, right? So President Trump imposes a 25% tariff on Canada and Mexico and 10% tariffs on China. And the other headline from NBC News says that Trump puts US tariffs on thousands of goods from Canada and Mexico, risking higher prices. Two more headlines. The Global News reported that Canada, retaliating against those tariffs, has put tariffs of their own on US products. And the other headline that you can see here is there's now a trade war with Europe, and that puts $9.5 trillion at risk. So all of this sort of put together, summarized on one slide, you can see that the tariffs are going to increase the cost of goods. And also, the tariffs were initially put on by the US against Canada and Mexico. Then they were put on hold for about a month. Then they were put back on again. And then they're on hold again a little bit. I think it's April 2nd is the most recent news headline that the tariffs will be coming back on again. So this is also leading to uncertainty. And the stock market does not like uncertainty. Investors don't like uncertainty. So there is a big question mark as to what is going to happen. Are the tariffs going to stay in place for the long term? Or are they just here for the short term? How much are the tariffs going to be? What is the retaliation from other countries going to be? So there is a lot of uncertainty. And that's why this is the graph that you see on the screen here from the last 3 months. And this is why the stock market is doing what it's doing. And so, again, big decline in the stock market recently. So then where do we go from here? Is the stock market going to continue to fall, or is it going to go up again? Or maybe it'll just flatline. We don't know. Is it going to go up or down? What's going to happen? So in order to help us figure that out and to make some type of educated guess, we're going to have to go look briefly at the past. What has happened in the past when we have seen market declines to the stock market? So just quick two definitions here. The stock market crash is defined by a decline of more than 20%. Okay, and a stock market correction is a decline of more than 10%, but less than 20. So I showed you in the first couple of slides, as of this recording, we're looking at a decline of about 8%. So technically it is not a crash, and technically it is not a correction either. Now, who knows what's going to happen in the next few days, in the next few weeks, or the next few months. But I just wanted to get those two definitions out of the way first. So now let's take a look at the past. We're going to take a look at sort of 5 major market declines. And we'll see how much was the decline and how did the stock market react. So, of course, the biggest one is going to be Black Tuesday, October 29th, 1929. Now, right before October, in the month of September, the stock market had reached an all-time high. And then on October 28th, the Dow fell by 13% and 12% the following day. And by mid-November of that year, the Dow was nearly half of the level of its September high. The market continued to fall over the next few years as economic difficulties of the Great Depression set in. The market finally bottomed in July of 1932, with the Dow closing down 89% That is huge. So I'm going to say that again. That's an 89% drop from its previous high in September of 1929. And the market would not regain its September high from 1929 until November of 1954. So that is a little scary. That is a 25 years later. That's how long it took for the market to get back to where it was in September of 29. And that was a very unusual circumstance. That was the Great Depression had set in. But nevertheless, that is what it is. And that's, how long it took for the market to recover. We'll see shortly. Other crashes have not taken that long to recover. That was an exceptional case. The next one is Black Monday, October 19, 1987. You can see the graph up on the screen. And just looking at that graph is a little scary. That is a huge drop, right? You look at that and that is an incredible drop just in one day. So that is known, Black Monday is known as being the largest single day percentage decline in the US stock market history. On that day, October 19, 1987, the Dow fell by 22.6%. Now the good news is the market recovered quickly after that. The stocks closed out 1987 with a small gain for the year, and less than 2 years later, the market had regained all of its losses from the crash. So that's certainly a lot better than what we saw during the Great Depression. So less than 24 months, and the market was back to where it was before. The next one is going to be the dot-com bubble crash, and I have personal experience with this because I lived through that period of time. On April 14th in 2000, the NASDAQ, which is another stock market in the US, fell by almost 10%. Its second biggest single day decline ever at the time. And by the time the market bottomed out in October of 2002, the NASDAQ had lost nearly 80% of its value. Now, what's important to note here is not all stocks were crashing, because the NASDAQ is primarily, even at the time, was primarily high-tech companies in there. So non-tech companies, some of them had stable growth and earnings, but they were ignored by investors during the tech boom. So, because everybody was putting their money into tech stocks. So even as the tech stocks tanked, the non-tech stocks, tech companies, continued to do okay. For example, Berkshire Hathaway increased by more than 25% in the year 2000. And insurance company Progressive shares were up by 40% in 2000 and in 2001. And then finally, the financial crisis in 2008, 2009. Again, I have personal experience of having lived through that and holding on to a dividend stock portfolio during the dot-com bubble and during the financial crisis. So from the end of September to early December, the S&P 500 back in 2008 lost between 7 to 8% of its value in a single day. The market eventually bottomed out March of 2009, with the S&P losing nearly 60% from its peak in October of 2007. So it took until April 2013 to surpass the previous high. So it did take a while, but again, not nearly the 25 years it took to recover from the Great Depression. And then, we have one more. I thought that was the final one, but we do have one more. COVID-19 in 2020. So March 16th of that year, the Dow dropped nearly 13%. The largest single day percentage drop since the 1987 crash. After reaching an all-time high on February 19th, 2020, the S&P had fallen 34% by March 23rd. One of the sharpest declines in history. By August of 2020, the market had reached a new high and continued to go up through much of 2021. So that was a quick recovery in the stock market. It didn't take very long for the stock prices to come back up again. So if we take a look, and this is a big graph, it's going all the way back to 1870. And what it's showing here is the growth of $1. So if you invested $1 back in 1870 in the stock market, today it would be worth over $30,000. And you can see on the graph there's lots of other crashes. We only talked about 5 of them today in this episode, but there's a lot of other crashes and events in history that caused the stock market to crash. And you can see them highlighted on the graph. Now, the important thing to note is taking a long-term perspective. For sure, if you look at just 6 months or even 12 months or even 2 years, you can see big declines, right? Of course, we talked about in 1929, we talked about the Black Monday in 87, right? So you can see declines in there, but if you step back and zoom out and look at the graph over a longer period, let's say 10, 15, 20, 30 years, over a longer period, the market has done well. And that's what we always talk about as dividend investors, is to take a long-term perspective. And especially if you're you're investing for your future, for your retirement, depending on your age, you may have 10, 15, 20, 30, 40, 50 years to go. And so taking a long-term perspective shows that throughout its history, since 1870, the stock market has continued to do well. One more graph here, because I was originally talking about the Dow Jones, so this one only looks at the Dow. So if you look at the Dow Jones index, and this one goes back to 1886 until, more recently, I think the graph is going up to 2025 here. The red bars represent a decline. And so we do see red bars. So we do see years where the stock market goes down. But what's important to note here are the blue lines. And there's more blue lines than there are red lines. And if you look at the blue lines, they show you that the market recovers from its decline, and even better than that, the returns are greater after its decline. And I think this slide here shows it the best, right? So this goes back to 1987. So we've got Black Monday here. We've got the tech bubble, the financial crisis, the COVID sell-off. And you can see that after a market decline or a crash or a correction, the preceding 12 months, the market eventually, of course, you can see on the graph here, there's positive returns. And then more than 12 months later, let's say 2 years, 3 years, it's giving you even greater returns than what the losses were. So this should give you some level of confidence, at least it does for me, when we're looking at the sort of the last 3-4 graphs I just showed you here, that having a long-term perspective, I know things don't look good right now and they seem very scary right now, and there is a lot of negative news 24/7 as to what things are going bad, everything's bad, the market's declining, prices are going to go up, and it's hard to remember, but it was the same level of fear that we've seen during COVID-19, during the financial crisis, during the tech bubble, throughout other periods in history where the news was negative and it was the same thing. Everything's going to crash, it's going to be a recession, and things look really bad. And that's why we want to have a long-term perspective. Now, most important for you then is, how do you invest now? So what do? Do you just sit back and do nothing? Do you invest? Do you wait? What's the next step? So I have a couple of suggestions for you. I've been a dividend investor for more than 25 years now. I've been investing in dividend stocks, have personally gone through a number of market crashes. So I'm going to share with you some of my ideas that will hopefully inspire you with some confidence and give you some next steps. So, number one, remain calm. The worst thing you can do is sell at a loss when the market is down, because that's when you solidify your losses. And it doesn't matter if you have mutual funds, index funds, ETFs, or stocks. If you sell any of those investments when the market is at its all-time low, you are going to solidify your losses. So remain calm and don't panic. The key is to remain patient. And you want to wait for the dust to settle, right? I know we're just in the middle of March, and I know there's April 2nd was the latest news about the tariffs coming back into effect. It's better to be patient rather than to panic and react to the news on any given day. So wait for the dust to settle. If you want to wait a couple of weeks, if you want to wait a month or two, that's fine, to see where things are going to settle. Is the market going to start creeping back up again, or is it going to go down? So you could wait. I know some people like to do dollar cost averaging, which is I'm going to invest a little bit of money now. I'm going to wait 2-3 weeks. I'll invest a little bit more, wait a couple of more weeks, invest again. That way, if the market continues to drop, well, I'm going to take advantage of lower prices, 4 to 6, 8 weeks from now. Or if the market starts to go up again, well, at least I'm buying at a lower price today. So that's entirely up to you, but the key here is to wait for the dust to settle. Tariffs or no tariffs? We don't know. Are they going to be in place? How long are they going to be in place for? Are other countries going to retaliate? What's going to happen? I don't know. I don't have a crystal ball to tell you what the future looks like. But the key here as an investor is to think about what are the products and services that people will need to live on. So food, clothing, banking services, insurance, right? Mortgages. People still need all of these things. Telecommunications. You need a way to, cell phones. You need that to communicate, to get on the internet. So there are things that people will need, especially if you live in a cold climate. You have to heat your home, so it'll either be natural gas or electricity. When you get home at night, you turn the lights on, so there's electricity. So there's utilities, right? So these are the product and services that people will still need. And it doesn't matter which country, if you're in the US or you're in Canada or you're in Europe or anywhere on this planet, doesn't matter which country you're in, you will require product and services in order to continue to live. So those are the kinds of things that we want to consider. And so the next thing I want to share with you is to invest responsibly, right? So it's not to panic, remain calm, but to invest responsibly. You never want to get into a position where you're blindly handing over your money, your hard-earned money, to either a mutual fund company or a financial advisor, unless you're getting really good advice. But that's on you to be able to ask the right questions to make sure that you're investing responsibly. Either you or someone who's doing it on your behalf is investing responsibly, and not to just haphazardly put money in any stock that's trading out there. So how do you do that? How do you invest responsibly? And to do that, I've designed a couple of investing rules that are designed to lower your risk. That's their entire purpose, is to lower your risk, save you time, and help you earn more. Now, I talked about some of the things just a minute ago, right? What are the products and services that people will still need, even if there are tariffs in place, or if there are not any tariffs in place? Even if there's a market crash or a recession, what are the products and services that people will need? So that's one of the rules, and we're going to get to it just in a couple of seconds here, right? So let's take a look at the rules to help you invest responsibly. And again, if you're not investing on your own, if you're not a do-it-yourself investor, that's fine. But you want to make sure that whoever is investing your money on your behalf is looking at these rules and using them as a guide to invest responsibly on your behalf. And if you want to do it yourself, that's great. That's what we do. And that's what I've been teaching for more than 20 years. And so how do we do this? Is to apply the 12 rules of simply investing. So rule number 1, do you understand how the company is making money? You don't need to be an expert at it, but just in simple, plain English, you got to be able to explain it to your grandmother or to a 14-year-old of how a company is making money. Rule number 2, 20 years from now, will people still need its product and services? Right? We want to make sure that you're investing money in companies that are still going to be around for the long term. Does the company have a low-cost competitive advantage? Right? And we're only at rule number 3, but you have to make sure that before you invest in any company, that it passes all of the 12 rules. If there's one failure, skip it, move on to something else. So rule number 4, is it recession proof? And that's what we talked about a couple of minutes ago, right? What are the products and services that people need to live on, regardless of if there's a recession or not? Rule number 5, is the company profitable? So we look at a 20-year graph of earnings per share, and we want to see earnings going up in the long term. Sure, you can have 1 or 2 years where the earnings are down, but in the long term, we want to see the earnings going up. Number 6, does it grow the dividend? Right? So the dividend is the money, it's profits that the company is sharing with you, the shareholder. So if a company is paying a dividend of $1 per share and you own 1,000 shares, you're going to get $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. And the dividend is going to be your margin of safety, right? Even if the stock price goes down, you're still getting the dividend. And eventually you want to get to a position, I've got lots of episodes on that, on how to live off of your dividends without having to sell a single share in your stock portfolio. Rule number 7, can the company afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any company with a recent dividend cut. Rule number 10, does the company buy back its own shares? Rule number 11, is the stock priced low? And that's important, right? You've all heard the phrase buy low, sell high. So you want to make sure that when you're buying a stock that it's priced low. And given the recent declines in the last 7 days, there could be opportunities out there to purchase high quality stocks that pass all of these rules that are now priced low. So that's important, at what price you're making your investment. And rule number 12, keep your emotions out of investing. And we've talked about that in today's episode, where I said remain calm, remain patient, and remain disciplined to apply these 12 rules before you buy any single stock. So to help you with that, I've created an all-in-one solution. And this is a little bit different than what we had in previous years. This is an all-in-one solution. It includes the Simply Investing web application and our investing dividend course. The Simply Investing app, you can see a screenshot up on the screen right now, tracks all of the stocks in the US and in Canada. So I think there's over 6,000 stocks in the US and Canada, and it applies the Simply Investing criteria to all of those 6,000 stocks every single day. So you can see immediately which ones pass the rules we looked at, which ones fail which of the rules, and which companies are either undervalued or overvalued. So you know which ones to ignore and which ones to consider. So a lot of the heavy lifting is done for you, and it's updated every single day, and it's an easy to use app. You can also track your portfolio there. You can also take a look at estimating your dividend growth, estimating at what your portfolio would look like 5, 10, 15, 20 years down the road. And you can set up alerts. And we've got an incredible amount of alerts. You could, for example, say, email me when a certain stock is at $50 a share. Email me when a certain stock becomes undervalued. Email me when a stock is overvalued, where you may consider selling it if you own it. And so we have, and tons of other features that are available in the app. The Simply Investing course, it's an online video course. It's in 10 modules. So we cover the investing basics. We cover the 12 rules of Simply Investing, show you how to apply the 12 rules with real life examples. We also show you how to use the web application. In module 5, I show you how to place your first stock order if you've never done it before. It is simple. It's simple as paying a bill online. And module 6, we show you how to build and track your portfolio. Module 7, when to sell your shares. Module 8, how to reduce your fees and risk, especially if you own mutual funds, index funds, and ETFs. Module 9, we give you your action plan to get started right away. And in Module 10, I answer your most frequently asked questions. So if you're interested, you may want to write down the coupon code SAVE10, 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 and you're going to be able to save 10% off of our all-in-one solution. If you enjoyed today's video, be sure to hit the subscribe button, hit the like button as well, and for more information, take a look at our website, simplyinvesting.com. Thanks for watching.